Everybody. Welcome. All right. UK mortgage approvals are set to fall by 13%, according to a new report. I'm going to go through some of the detail of what that actually means and get into what's actually going on in the background here. This isn't about the property market per se. It will have something to do with it, but it's not exclusively about the property market. There are some other bits and pieces that I think are going on here. And so that's what I want to go through, just so that you guys, if you are a first time buyer or you're looking to remortgage, can kind of take this information and use it as your, I guess, barometer for research, essentially. Yeah, let's kick this off. And before we begin, I just want to say thank you to everyone who wished me a happy birthday on Monday's video. Really appreciate it, guys. Thank you so much. It's really nice to kind of see the support and the well wishes. So thank you very much. All right, so this is what we're talking about right now. Let's have a look at the article that I found online this morning, and we are going to talk through what I think is actually going on, so that you guys can obviously use it for your own research as well. Okay, so this is by Octane Capital. So I'll link this down below after this is all done. But basically, this is the main point here. Mortgage approvals for residential house purchases are specifically set to fall to 818,641. This is from last year, right? Which represents a 13.4% fall, says a lender. So basically, what they're saying is the number of approvals for residential house purchases are going to be falling by about 13.4%. Now, why is this important given where we are right now and the environment that we're in right now? There's a lot of talk about, obviously, interest rates, right? We covered on Monday that there was something in the budget last Thursday around mortgage bailouts for people on universal credit. I actually might speak a bit about that later on, because there are a couple of points that I've seen in the comment section, and I don't necessarily think people realize that there's a lot of working people on universal credit, but we'll talk about that in a moment. There is also a question that also needs to be answered that we don't know the answer to just yet. But essentially, we know that there was that mortgage bailout in the budget last week. We know that property prices, they are predicting, are going to fall by double digits next year, which will potentially facilitate further falls in the property market. So when you think about it logically, right, you may be thinking, well, if property prices are falling, why would mortgage approval rates also be falling? It doesn't necessarily seem as though those two things will be linked directly. Now, one of the things that isn't necessarily being spoken about now is the fact that unemployment rate is rumored or is forecast to go up to around about 6.5%, which was the level that we were at back in 2007, 2008, when the last big market crash essentially happened. A lot of those job losses haven't come through just yet. So at some point next year, they're expecting that unemployment will go through the roof, and therefore you're going to have more defaults in the marketplace as people start to struggle with paying their mortgages, especially when you consider that 2 million households are going to be coming off their fixed rate. So all of these kind of things are conspiring. But it's important to note that, let me just get rid of this very quickly, just so you can properly see me. It's really important to note that from a lender's point of view, what lenders typically tend to do in periods of a recession, where there's uncertainty, where there are market fluctuations, especially when interest rates tend to increase, is they will tend to tighten their affordability criteria. So when you apply for a mortgage, right, as a first-time buyer or someone who hasn't actually had a property before, you have affordability criteria that you need to meet. And this affordability criteria will take into consideration where you've worked, how long you've worked there for. Are you on a permanent contract? Are you on a temporary contract? If you've just started a job, they may say, well, actually, you need to come out of your probationary period in order for you to be eligible for this mortgage, because what they're trying to do is they're trying to manage their risk of lending you this money and having to go through the repossession process. So the affordability criteria increases. Also on the affordability criteria is the affordability test itself, where they start to have a look at your income and all of your expenditure. And particularly if you are in a position where you have an overdraft, you have credit cards, you have car finance, you have all these other kinds of debts like payday loans or personal loans, that amount that you're spending on a monthly basis towards those debts will get deducted from the amount that you can borrow. So let's just say you are earning £25,000 a year, and the multiplier in terms of how much you can borrow says it's 4 times your annual salary. So that's £100,000. If you had debts of, say, £15,000, then that £15,000 will reduce how much you can borrow. So now you can no longer borrow £100,000. You may only be able to borrow something like £80,000 or £75,000. That's affordability tested. And again, you have to think like the lender does. What they're looking at here is, right, okay, so he's got to keep up payments to these facilities. We're going to lend him money for this house. They want to stress test you. And the reason why stress testing is so important is because of precisely the situation that we're in right now with rising interest rates. So think about it, right? If you're a lender and you're going to lend someone £100,000 for a house, right? If, for example, we get you on a fixed rate mortgage right now, and let's just say it's really cheap, I'm going to call it 4%, right? Although there aren't that many out here at the moment, but just take it as a number, 4%, right? We know that your payments are going to be X amount per year for the next 2 years, fixed or locked in, or even 5 years locked in. But you still have this debt. And we know at the point of application that this debt is going to run for the next seven years, or maybe even 5 years. And we know that actually in 2 years' time or 5 years' time, when your fixed rate ends, interest rates might go up. That means that you're still going to have this debt right here that we know about now that you're still going to be paying off, plus this mortgage that will see interest rates increase, and this also will increase in value. So what they're looking to do is basically give themselves an element of, well, some room for error, essentially. And that's why they have affordability criteria. What we're seeing here is in this article is they're saying they're looking to see that mortgage approvals for residential properties is going to fall by 13.4%. This will be as a byproduct of the affordability testing that the lenders will do. They always tighten affordability during recessionary periods. Now, it just does say here that by contrast, approvals for mortgages are set to jump by 24% on an annual basis, while approvals for those classed as other, such as existing borrowing, increasing the size of their current mortgages with the same lender, are also expected to lift by 7.6% year on year. What does that mean? If you're looking to remortgage, so if you have a mortgage currently, you're coming off a fixed rate deal, you're likely going to be accepted for one of those because the reality is you already have a track record. And you're probably going to have equity in your property anyway. So those mortgages specifically, so if you're going from a fixed rate to a fixed rate, maybe you want to borrow some more money, they're expecting that those will increase. It is for new residential purchases that they're anticipating, that they're forecasting are going to fall by 13.4%. So I guess the question is, for first-time buyers, what do you do? Look, I think you should go and see a mortgage advisor. You should definitely sit down with a mortgage advisor. There are so many moving parts here, guys. Like property price falling. Yes, you might be able to buy a property for much cheaper in comparison to the prices right now. But on the flip side, you have interest rates that will they will go up, and it's a question of how much it's then going to cost you in increased payments because of interest rates, right? And if you do have debts, the affordability is going to impact how much you can borrow. So you need to kind of weigh that up. But with that being said, with property prices falling, you probably won't need to borrow as much. But it still needs to go into that equation where you need to speak to a professional. My biggest piece of advice, I guess, if I could give advice on this, and this is just my view from being a mortgage advisor and having gone through this process a number of times myself, is if you're applying for a mortgage to buy property, you really want to carefully consider how much debt you have. And you want to try and really pay down as much of that as possible, because, different lenders will have different criteria. So if you had 15 grand, are you 15 grand in debt, as the example here, right? They don't reduce it pound for pound. You would think that they would, but they don't. They factor in other bits and pieces as well. So that £15,000 could cost you 20 grand in how much you could borrow, which is pretty significant. It could cost you 25 grand. It's pretty significant. So really the best place you could be is to pay off as much of the debt as possible before you get to the point of actually applying for your mortgage, because that puts you in the best position possible. When they do all of the affordability checks, they will know, look, it doesn't really matter if interest rates continue to rise, they should be able to afford it. Because from a lender's point of view, all they're interested in is reducing the risk on their side. That's what they're interested about. And if you have zero debts, that means that potentially there is less risk for them. And that works pretty well in terms of the compliance and the risk management tick box that they have to tick. So please pay attention to your debts. Really, really pay attention to your debts. If you are using things like payday loans, well, payday loans are a big negative on most for most applicants. Even if you're going for things like overdrafts or personal loans, oftentimes payday loans are they're not good at all to actually have. So try and pay down as much of your debts as possible. But that's what we think is coming in the next year: 13% reduction in mortgage approvals. I did say that I was going to mention something around the universal credit. So on the last video on Monday, a lot of people were saying, well, so how are you on universal credit with a mortgage? And actually, I think the number is about 40% of working people. I think that's the number. Don't quote me on this, but the number's pretty high. 40% of working people are on no, sorry, let me just get this right. 40% of the people on universal credit are actually in full-time work. Now that might blow your mind, but how does that actually work? Well, if you have kids, right, you can pretty much apply for and you will be eligible for universal credit, as long as obviously income thresholds don't cost £50,000. So if you've got Mr. and Mrs. and they're both on £30,000 each, that's an income of £60,000, and they have kids, they are eligible for universal credit. And like I said, there's a big portion of people on universal credit in full-time jobs. You wouldn't think it, but it is true. And so the bailout that we talked about on Monday, that was in the budget on page 49, paragraph 5.16, I think it was specifically targeted to help those people where they might be coming off a fixed rate in spring, and then they're struggling with paying their mortgage because interest rates have risen so high, or God forbid, one of the two has been made redundant or has lost their job because they're expecting unemployment numbers to come in. So it is a very, very common thing. We don't yet know what's going to happen and if the government are going to bail out or offer a bailout to other people who aren't necessarily on universal credit. My guess would be no, because if you're not on universal credit, you probably don't need the help, is what the assumption that the government is making. But who knows what's going to happen, right? We'll have to cross that bridge when we get there, and I guess report on it when we have more information on those kind of circumstances. But it's going to be very, very interesting between now, the spring, when energy prices, well, we've got the cap for the budget up to £3,000, but it's still going to be an increase, right? But when the fixed rate mortgages start to roll off, that's when it's going to get really, really interesting on the mortgage side. Anyway, guys, thank you so much. Let me just pop this comment up here, because if you haven't already, please smash the like button. There are 66 people at the moment, I can see. Around about there, yeah. We've got 10 likes on there. So let's at least get the likes on to up to 30. How this works, and I will always explain this, is other people may want to see the content of this just to kind of get the benefit of what I've explained in this video. But YouTube will not push it out to them unless there is a really good interaction on the video. And that means people are able to smash the like button and interact with the video itself. So that's why I always ask for you to smash the like button. It's not a vanity thing, but it is very much about YouTube and other people being able to access the information that we have on this channel as well. VM, thank you very much. You said a big fan of the channel and appreciate your insights. Thank you, mate. Thank you for watching. Let's see what else we got here. Matt is asking, can I get a mortgage at 55? What term would I be able to get a 20-year term? Maybe not a 20-year term, Matt, sorry. I had this question on... When did I have this question? I had this question... There was a question. I don't think it went... We actually used the question in the end on Channel 4. Basically, if you go and apply for a mortgage now, the lender is probably going to ask you what your pension provisions are. So your retirement and income, basically, because what they'll want to know is if they're going to put you on a 20-year term that will take you to 75. They'll want to know, right, do you have a pension in place that could service the mortgage payments, essentially? So they will ask you for pension information. They want to know what arrangements you have, because again, they're trying to limit their risk. If you are likely to retire at, say, 65 or even at 70, you're still going to have 5 years on top of that. So they want to make sure and try and gauge before they give you the mortgage whether you have a sufficient pension income to fund the mortgage repayments. So you can get a mortgage at age 55. Yes, you can, but you may be a little bit restricted on term. You should definitely go and see a mortgage advisor that will look at the whole of the market for you. Different lenders will have different criteria. Some people will go up to 75, but some people won't. So you need a mortgage advisor that can go and source the market and whittle down that criteria for specifically what you're looking at. But you can. It just means that you may need to provide, and you will have to provide, some pensionable income details for the lender. Ah, Budget Bear just saying I'm one of them, but you have a disabled child. Um, you should be, yeah, you should be on university. You should be on means tested for sure, 100%. Um, Visual just saying you get 15 plus there. Okay, cool. All right, guys. Look, I wanted to make this relatively short. Thank you so much for watching, and again, thank you so much to everyone for the support on the channel, and thank you for the well wishes for yesterday. It was really cool. It was nice to see, and I appreciate every single one of you. Please let's get those likes over 30. We're at 28 right now. It's just another two. You know what you can do. Very easy to do. All right. Cheers, guys.